Hey everyone, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to talk about gamma. Now, if you're new to this is a show where we construct concepts visually for you. So last week we got into the Greeks. So what the Greeks are, you'll see them on all the platforms, Thinkorswim, Doe. They're basically variables that you can use to get a better sense of different things about your portfolio. So last week we got into delta, which is the rate of change of an option's price, and we basically learned how we can use that to hedge our positions, see what our potential probability of being in the money is, etc. So today we're going to look at gamma. And the reason I talk about delta before gamma is because gamma is essentially a derivative of delta. So if delta is the rate of change of an option's price, that's a derivative of the option's price. We've got delta, and gamma is a derivative of delta. So basically what gamma is the rate of change of delta. So it's great to know and learn all these different Greeks because once you learn them and understand how they work, it gives you a better sense of how different market aspects are going to change your option position. So without further ado, let's get into gamma. So again, gamma is the rate of change of delta. So what we're going to do here is take a look at an example of a trade. We've got a 75 stock price that's at the money. So we're going to look at an increase and a decrease and see what happens to the option price, the gamma, and basically the stock price and how all these things kind of coagulate together. So right now we're looking at a 45-day till expiration call. So if I've got a stock price at 75 and the option price is at 290, and I know that the delta is the rate of change of the options price, if we go from 75 to 76, my option price should theoretically increase by 50 cents, which you can see here. So the option price increased from 290 to 340, given a $1 increase in that stock price. So we can see here that the delta has changed from 50 to 55. And that's because we had a gamma of 5 cents. So this is how everything kind of works together. So again, we've got our stock price at 75, we're looking at an at-the-money call. So if I were to purchase that call, for example, and the stock price goes up to 76, if that call was worth 290 and had a 50 delta, which is what you'll see with at-the-money options, they're most likely going to have a 50 delta because you're going to have a 50% chance of being in the money. And as we learned last week, a delta is essentially equivalent to the probability of being in the money. So we've got this rate of change here, which you can clearly see in the option price increase. And now you can see that our delta goes from 50 to 55. And that's because we have a gamma of 0.05. So what does this tell us? So basically what this tells us when we have longer days till expiration trades is that our gamma risk is low. So what you'll hear on the Doe, if you're looking at the follow page, people might refer to something as having a low or high gamma risk. So what we like to do is avoid gamma risk altogether, because basically what gamma risk is the rate of change of delta, and if that rate of change of delta is very high, it can basically swing my option price down or up, and that's not something I want to do if I'm trying to be mechanical and stay in a high probability environment. Because if my option price is swinging up and down, it's going to have a lot of variance, and I might be a loser one second and a winner the next second. So that's not something I'm really interested in if I'm looking to get high probability trades over longevity rather than direction. So let's see what happens when we go down one strike. So basically if I buy a call and the stock price goes down and that call option had a 50 delta, or a 45 delta I should say, then my option price should decrease 45 cents, which you see here. And that's because when you're changing from delta, although the gamma is going to change, it's going to increase and decrease with that stock price movement. So you can see that the option price decreased 45 cents because we're looking at the delta here of 45 cents. So again, the real takeaway here is that when we're looking at 45 day till expiration trades, or trades that are not in expiration week, so expiration week is known to have high gamma risk, you can see that regardless of whether the stock price moves up or down, the option price doesn't sway too drastically. So now we're going to compare this to a much closer to expiration trade, and we're going to look at a 2-day till expiration call spread. So if we look at the next slide here, we can see that we've got the same information, so we're going to just keep it consistent. We've got the 75 stock price. We're going to look up and down one strike, and we're going to see how our option prices are affected now given an increase in gamma, because again, the closer you get to expiration, the higher gamma is going to be, and that's where that gamma risk comes into play. So we've got a 75 stock price, and now we're looking at an option price of 65 cents. So the option price is worth a lot less because we only have 2 days till expiration. So regardless of where I am, except for in the money options, it's going to be a lot less because there's a lot less extrinsic value, which we learned about in a previous whiteboard. So extrinsic value is made up of time and volatility, and they kind of combine together. So the less time that there is for a stock to be volatile, the less value there's going to be in that extrinsic value. So now we're looking at a gamma of 0.25. So now we've got the option price at 65 cents. We still have the same delta of 50. So you can see that if the stock price goes up $1, now my option price almost doubles. So we've got this big swing going up one point here in the stock price, and now you see that the gamma is much higher. So it's 5 times the value of our previous example. So now my delta changes from 50 to 75 as opposed to 50 to 55. So this is just going to go higher and higher. So if I was looking at an option price now of 115 and now I've got a delta of 0.75, now if there's another increase, it's going to increase another 75 cents, which is almost 100% of that value. So that's where the gamma risk comes into play. So a 2-point move can drastically change this option price. So you would see if this was 75 cents and $1.15, so now it would be $1.90. So this option price has now pretty much tripled with a 2-point move in the stock price. So if I sold this call here instead of buying it, then I might be at a loser already with just a 2-point move. And that can happen at any time because you know stocks go up and down. There's a lot of random variance in that intraday movement. So that's why we like to avoid this gamma risk here. So let's look at what happens when we go down. So if we're going from 75 to 74, if I bought this call at 75 and it was worth 65 cents, if I have a delta of 50 and we're going down to 25 cents, now this is going to decrease 25 cents here. So basically I've lost 50% of my value in just one stock point move. So again, you can see that gamma being high is not really good if I want to hold that delta or hold that option price, because when we're looking at a high gamma, we're looking at a high rate of change of delta, which means that when you're looking at a bell curve, so we're going to look at this on the next slide here. So if we want to throw this up, this would be a great time to talk about it. So when you're looking at a longer term day till expiration bell curve, you're basically going to have a wide range of strikes, and the bell curve of probabilities is going to be pretty wide across those strikes. So as you can see here, we're looking at a 45 day till expiration call delta curve. And if we're looking at the 75 stock price and we're looking at just the call side, so we're looking below the stock price. So what happens when the stock price goes from 75 to 74? You can see that the delta pretty much holds its value, so the delta doesn't change too much. So what you're going to see in relation to that option price is if you're going from 75 to 74 to 73, since the delta is holding its value, you'll see pretty much a stair-step decrease in the option price. Now, if we compare that to the shorter term days till expiration, so we've got the 2 days till expiration here, you can see that since there's less time for the stock to be volatile, basically our standard deviation curve goes from this to something much smaller that's wrapped around the stock price. So what you see here is the reduction in the price from 75 to 74 basically reduces the delta much more drastically. So you can clearly see that this has a much higher gamma than the blue line above it. So if we're going from 75 to 74 to 73, now instead of a steady stair-step decrease in the option price, we've got kind of a drastic slope down. So regardless of whether I'm buying an option or selling an option, let's say I sell an option at 74 and the stock price goes to 75. Now, of course, I sold it here, but now it's worth this much, so I'm going to be seeing a loss right away. Whereas if I sold an option at 45 days till expiration at 74 and then it went to 75, you can see that my increase in the option price isn't too drastic, and I can pretty much hold that value, and I still have plenty of time to be right. So it's a much better situation in our eyes. So let's get some takeaways here for gamma. So the very first one is gamma is the rate of change of an option's delta. So again, if I've got an option price and I know that delta is the rate of change of that option price and gamma is the rate of change of that delta, now you can see how they kind of interact. So they're all tied together, and that's what you're going to see once we start learning more about all these Greeks. We're going to look at theta tomorrow, and we're going to get into some others in the future, but you can see that they're all going to be tied together, and that's what kind of creates this matrix of option price movement. The next one is gamma risk grows as expiration nears. And that's because, like we were just showing before, when I'm looking at 45 days till expiration, I've got a standard deviation curve that's pretty wide, and that gives me a better range to be correct, and it's going to have a lower gamma risk because the deltas hold their value from a 1-point move to a 1-point move. Whereas when I reduce the days till expiration, that bell curve gets really narrow. So when I'm going from those 1-point moves to the other 1-point move, you'll basically see a greater gamma or a greater change in delta, which is something that we like to stay away from. So what we can do when we're trading to stay away from that is, if I'm getting to expiration week and I know that gamma is going to be increasing, I can roll my trade into the future, which basically reverts my 2 days till expiration chart back to the 45-day, which we're comfortable with. And last but not least, gamma can be thought of as the stability or instability of an option's probability. So we know that delta can be thought of as the probability of being in the money. So if I know that gamma is the rate of change of delta, if I've got low gamma risk, then that would give me a pretty stable delta. So if I'm looking at a 45-day till expiration trade and the stock's going up and down a point, it really shouldn't affect my option price too much. Where on the other hand, if I'm looking at an instability of an options price, I'm going to know that that's going to have a high gamma value. And that's because since gamma is the rate of change of delta, if I'm looking at an unstable option price, given a $1 increase or decrease in that option, or the stock I should say, then I know that I'm in a high gamma risk environment, which is what we like to avoid. So again, we would roll into the future in that scenario to avoid it altogether. Now this has been Gamma. If you've got any questions at all, send me an email at support@do.com or support@. And we are actually going to have a blog post on this, so we're going to be releasing a blog post in the next few days. So if you go to do.com/blog, it's a great source of written content there, written information if you need anything else on that site. We've got plenty of different strategies as well. But you can also tweet us at DoTrading, at Trader Mike. So tomorrow we're going to continue with our Greek discussion. We're going to talk about theta and basically how that affects an option price. And then we're going to step away from that and get into a little strategy on Thursday and the beginning of next week. But we will come back to discuss Vega and Beta as well, because those are pretty much the 5 Greeks that we like to look at here at Tastylive. Thanks so much for tuning in. Until tomorrow, my name is Mike, and this has been Mike and his whiteboard.
What up, everybody? I hoped you liked this video. Click below to watch more videos, subscribe to our channel, and don't forget to check out tastylive.com.